the best way to bulletproof your finances is to actually
because what it always, based on everything that you've said, what it seems to come down to is commitment.
We can help you protect against the taxman. We can help you protect yourself against death, believe it or not. So, there's some things are going to happen to you in your life. You're going to pay tax. You're going to die. You're going to suffer from inflation. You need to see an advisor.
Good morning, afternoon, evening, whenever you're watching the podcast. Welcome, episode 79. I keep saying this every time, and I can't believe we've got one more on the Do More With Your Money podcast. Welcome, everyone. I don't think there's any introductions needed today. We've got a few regulars, and I think the first question is how are you since the opposite of lockdown, which is Steve?
What is it, Jimmy? Knock up? I don't know. They used to have knocker uppers, didn't they, in London? They used to go and wake people up in the morning. At my age now, I don't suffer from that. I find it difficult to sleep. No, great, Jimmy. Yeah, being able to get out and about, it's lovely. I've been going to London to see the kids, which is great for me, but I don't know how they like it. But I guess when I die, they'll tell us. But no, all good as far as I'm concerned. Coming back in the office, seeing everybody is great. It's good to be interacting with people face to face again.
Are you still wearing a mask? No.
It is, yeah. It's a very young Yorkshireman.
Good. No, but would you still wear a mask when you went out?
Yeah, I do. Yeah, I think it's prudent to do so. I think as we say, it's for other people, but equally, I do think you get some protection yourself. So there's a little bit of self-interest there. Yeah. But also, I think we should in public places. I'd make it law actually, but there you go. Oh, I'm a hang 'em and flog 'em in some senses, but I'd do that.
Yeah, I think I probably agree. And Steve, we have had some good news for you this week as well, which I thought I had to mention it. So you've been upgraded from a dad to a granddad. So congratulations.
Yeah, I got a lovely, gorgeous little grandson, Alfie George. So yeah, he was born in London though, so I'm not sure if he can play for Yorkshire anymore. But but no, he's gorgeous. Yeah, I'm obsessed by looking at my little videos I get, and I get to meet him this Saturday. So great.
Lovely.
Excellent.
Yeah, can't wait.
And hopefully a Yorkshire accent. You're gonna have to.
Well, it might be a refined accent like mine,
I suppose.
which you can't even tell them from Yorkshire.
No, not at all, Steve.
So, but you might have some kind of south of the river accent, but we'll beat that out of him.
Yeah. Great, congratulations, Steve.
Thank you.
And Jeff, how are you getting on now?
Yeah. I suppose pretty much the same, because there's a bit of a difference between the lockdown in Scotland and what we're seeing in England. So it's interesting just to see that contrast. We had a trip down to London last week with two boys, so that was good. Great to see London, nice and quiet as well. So still getting out and about on that and getting to see the changes coming through.
Excellent. I've actually booked Edinburgh, which for my anniversary in a week's time, and hadn't realised I've got to book bars.
You've got to, still have to book
2 hour slots, so I've kindly left that to my wife to do. It's not for me, I don't think. And then you, Diane?
Nothing's really changed for me, Jamie. I think, much like Steve, I'll still wear a mask and things when I'm going out. But as soon as, I think Jeff, you and I were on the podcast, as soon as the original unlock was done, the mini, both Jeff and I had plans consistently weekends after. So like you say, it's just nice to know that you've got the freedom. It's not necessarily that you are doing something. It's nice to know that you can if you choose to. So on a Saturday, you don't, unlike you going to Edinburgh, you don't have to plan anymore. I could decide I might just go out for a bite to eat, and I don't have to think, right, where can I get a reservation? Is it even worth it? It's nice to know that it is beginning to feel like it's getting a little bit back to normal. And if we have to wear masks in the interim, then so be it.
Yeah, I think from my experience, I think it is time to accept that this is not going away. And personally, from my experience, when I've been into shops and stores, most people have had masks on, so it's been interesting.
That was the same even in London. Tube, everything. Most people wear masks.
It's I think it's going to be probably similar to what you've seen in China, isn't it? Where you have a cough and cold, people start wearing masks. I think
it's easy. It's weird how quickly you become conditioned to do something. We've never ever worn them ever, and then all of a sudden, within a heartbeat, it's you don't necessarily want to not wear them anymore. You're all that little bit like shall I not kind of thing.
The only problem I have with them is, and I thought this yesterday, I think they're making my ears stick out.
Never,
so,
Steve.
Yeah, I might have to just reconsider.
I'm sure if you go to the NHS and complain, you'll be able to get your ears pinned back for free.
You might have to just get one of the clear visor ones.
Yes.
me think about that.
Or the ones that make you look like you've had plastic surgery, and they come across, they sit on your nose, but they come down so your eyes are still left.
Oh.
They're weird, really weird.
I think on that note, we'll get on with the topic.
Right.
Quickly moving on. So the podcast today, lady and gents, how to bulletproof your finances. But I think before we show a bit of bulletproofing, Jeff, can you give us a little bit of the standard market update?
Yeah, certainly. Markets this week and over the course of the month have continued to move higher, which has been pleasing to see this week. And it's primarily, I suppose, we're into what we call earnings season in the equity markets at the moment. So we have a lot of companies reporting results, which drive share price reactions, positive and negative. And it's been, I suppose, for us, reflecting on how companies that we own within the portfolios have been delivering, how our managers have been assessing that. Everybody will have probably seen the technology companies that have reported over the past few days. And really for them, the key thing has been ongoing strength in their business. There was quite a bit of discussion over the course of the past 6 months as to whether some of these businesses would be able to sustain the rates of growth that they had been seeing last year when everybody was at home, working remotely, etc. And lo and behold, they have. So it's, as we were discussing pre-podcast, 56 billion of quarterly revenue for 3 companies, which is quite phenomenal. 5 billion a week, effectively, over the quarter, which is quite an impressive profit figure to be generating. And it's across those businesses, and we saw the same again last night from Facebook, another strong set of results there. And what's an interesting reaction is that the market is appreciating that, and the market is seeing some of those stocks actually move higher, despite what people have sort of challenged as their valuations. So that's been really the key driver. The other key focus this week has been what the Federal Reserve in the US would say with their interest rate meeting last night. Expectation that they may move forward with some of their reduction in the quantitative easing program that has been very supportive to asset prices and asset markets over the past 12 months. A little indication that they see the economy continuing to improve, but no change to policy as yet. Expectation certainly is building, however, that does come through towards the August meeting, the September meeting, and we'll see them decide to step back on their support. To give some context to that, they're effectively purchasing $120 billion worth of treasuries and mortgage-backed securities on a monthly basis, which, if you extrapolate that all out and you take a step back and you look at it, the Federal Reserve probably owns 20 to 30% of the US government bond market, with similar numbers, if not higher numbers, by central banks in other economies. So that is, I suppose, the challenge for markets at this point, the interaction between central bank ownership versus how that gets resolved, and we're starting to hear the Federal Reserve talk a little bit about that.
It's interesting that we were talking about the tech companies prior to the sort of pre-podcast, and I think that one of the comments made on the news article I was watching last night was the consumer is addicted to tech. So this is why you're always going to see these sort of increases as long as they're innovating and making sort of new and good products. Yeah, the consumer is addicted to that, and I think that's what it's
just it's a different way of interacting as well. So technology is driving change in consumer habits, and then if you look at that, how that feeds into industry, and last year for some of these companies, digital advertising was really disappointing. Whereas as the economy started to reopen, the digital advertising side of their businesses has really stepped up, and that's been a strong driver of the growth, and that just is very much endemic of how we use our devices. You see a lot of advertising on it, unless you try and turn it all off, but even then it doesn't seem to work. It still seems to get its way through. But I think it does raise an interesting point in the sense that, well, regulation is something that's talked about. You think about the dominance is maybe the wrong word to describe it, because these companies have earned that position through reinvesting capital into their business and evolving and innovating, one would argue. But if you look at China as an example over the past couple of months, you have certainly seen a regulatory agenda change for technology businesses. Just this week, the private education companies in China came under a lot of pressure. Some of the stocks down 70% on the day. Now that's because of regulatory change, and we know that what is one of the things that governments may want to think about going forward, it's certainly regulation of these larger platforms, and that has to be one of those risks that is out there in the background.
Yeah, definitely, certainly.
It's interesting, isn't it? They'll deal with regulation. They're trying to deal with taxation of them as well at the minute, which sort of has worried people. I mean, they're so integrated into our lives now. You couldn't, and I think the pandemic as well has speeded it up. So people who didn't have fully integrated technology in the house now have it. It's just absolutely. I don't know how we do without it now. Even all my light bulbs come on and off at the command of my.
Well, that's the thing. We wouldn't. So obviously, a long time ago, when I was growing up, you would see phone boxes in certain places, and if you didn't have, we had when I was little, we had incoming calls only. We didn't have. There was really no need for an outgoing call, and it's just one of those things now. Is if you didn't have that device attached to your person somewhere, how do you get in touch with people anymore? You can't just wander down the street, pick up a phone box and dial a landline anymore. How many people have landlines? You have to have a landline for your broadband. That's largely it, really. And the whole thing is, I think if we were to look now, we don't have the network and the infrastructure in place that we had 10, 20, 30 years ago anymore, because it has moved on such. We simply couldn't survive without technology these days. Nobody would know what to do.
It's interesting because what did you do when you had to meet someone in
you
town?
Had to be there.
You had to be there at a specific
Exactly.
time, at a specific place, and now how life's changed.
Exactly.
And these companies obviously are obviously they dominate. They really do dominate, which is
just challenging for you, Jimmy. That must have been to be there on time.
I know. Well, we know what I'm like, so I would always tell someone I'm meeting at 10 o'clock, and they would wait for at least 20 minutes, and if I didn't turn after 20 past, there's a chance I wasn't going to be there. So.
Yeah.
But not too bad. There's this joke with me being 5 minutes late for most meetings.
I'm not sure I've ever witnessed that. Not at all.
I had to be fashionably late down.
Right.
Just too busy.
So it is. That's the problem. I'm just chasing my tail.
Spread yourself too thin.
Exactly. So just talking about we'll start with the bulletproof in your finances. So kind of looking at we've obviously just went through an unpredictable thing in COVID and markets, and I think obviously we spent a lot of time speaking to clients about ensuring that you stay in the market, you don't pull out, you don't crystallise that losses. I suppose start with you, Steve. What's the advice when it comes to how do you can't? I don't believe you can plan for an event, but you can from an investment perspective, but from an individual perspective, what would your advice be to them from an advisor's perspective?
My advice to everybody about looking after your own finances is think about the risks you're under, and one of the major risks you've got is yourself. That sounds really a bit naff, but it is. Anxiety builds up, and we've talked about this before about the markets and savings and the news. Things have changed as we've got older, in the sense that the news is all bad news now. You don't get any good news, and it builds anxiety within people, and it does within their savings and their horizons. And I think as people get nearer to their goals or a life event like retirement or a wedding or whatever, that anxiety can become really empowering to them, and they'll do silly things. So I think, and we've all done it. I've done it. I've made some terrible investments in the past that I've thought that's a really good idea, and thinking back now, it was too good to be true. And if something seems too good to be true, it generally is too good to be true. And I think you've got to just make sure you put your savings in an environment where it's not that easy to touch them, because I think you can react quickly on an anxiety or on just a little bit of worry coming through in the market, and you can do silly things. So you've got to protect against yourselves. So put your money into a plan, put a regular direct debit, get some regularity to it that makes it very difficult for you to get at it and to change it or to change the allocation. Use an advisor, set a goal and invest in portfolios that they're achieving your goals. It makes it far less likely that you're going to do something irrational. That's my advice to people, because it's the advice. It's taken me a lot of years, but I'm gradually teaching myself to, don't be erratic.
Yeah, I think the interesting I probably say this every podcast, but I do believe that actually before you start to invest, just think about what your destination, which is your goal, before you do anything. And the best way to bulletproof your finances is to actually set a goal, which could be, I want to retire at this point, and this is how much I need, and this is how I need to work towards it. And kind of everything that happens in between that time really is noise, because you've got a 30-year plan, and events like COVID and and market crashes will happen. At the minute, they seem to be happening every sort of 10 years. It's hopefully another 10 years, we don't know, but they will happen. You've just got to plan and say, actually, as we've seen with the current crisis, the market's picked back up. And just talking about goals, Di, what have we got in the technology? Just remind our viewers.
So within the technology, there's the ability to go in and actually create the account. So you don't have to be a current client of True Potential in order to use the technology. You have to become a client, but you can go on, and there's places on the site that will actually show you what it's like to create a goal. You can go on, you can choose what your investment amount will be, and you can say what you want that target to be. It could be 2 years, 3 years, 5, 10, 40 years. It's indifferent to us how long you want to plan. But what it does is it allows you to say, this is where I am now and this is where I want to be. And the site will actually tell you, well, if you want to be at X, you really need to have Y now. If you can't afford Y now, it will allow you to plot that along the way. It'll carry on, it'll tell you what your shortfall is. It will allow you to understand how you get from where your shortfall is up to your target. So the site does, it allows you, but it also allows you to understand your finances. For me, I do agree, you absolutely can't plan. You certainly can't plan for a finance event. No. You have no idea what's going to happen. But that comes down to things like boilers. Like when you own a home, talking about a house like a gas boiler, when you own a home, you don't know when that's going to break. So I think you have to have a happy medium between locking your finances away, but also knowing that you've also got custody, essentially, of immediate finances, that you're not just bulletproofing your investments. You're actually bulletproofing yourself by saying, right, this is where my immediate money is. This is where my long-term money is. And the site, again, allows you to do that. You can differentiate between a long-term investment and a short-term investment. You have to understand. You're right, Jim. You have to understand what you want, because if you don't, it's always going to be easy just to dip in or think, oh, well, I don't need that because I've got another 30 years. But 30 years creeps up very, very quickly. Before you know it, you're looking and going, I've got nothing. How did that happen? And then you might have a lot of nice things.
How old will you be in 30 years' time, Diane?
No comment, Janie. You never ask a lady your age.
48.
But
48.
Oh, thanks, Steve.
Good answer.
49, actually.
No, good. I think that, just to kind of touch on something little you touched there, is that element of a fund that allows you not to take out of your investments. Yeah. Investments need to be a 5 to 10 year to 30 year plan. If you need that money within 5 years, don't invest it. That would be my sort of advice from an advisor perspective. Create an emergency fund. We talk about 3 to 6 months as an emergency fund of what you really need, and that is your boiler breaking down fund. That is I might want to just pluck and get a holiday out fund. Yeah. So to look at them options, and actually in certain cases, especially with low interest rates at the minute, sometimes actually taking on a debt for something that you wish to purchase is better than pulling the money out. And we talk a lot about, so I have a lot of clients that come to me when we look at their final salary transfers, and their objective is, I want this much income when I retire and I want to pay my mortgage off, but they're still working for 5 to 10 years. And when we look at the analysis and we look to transfer, if it's appropriate, part of that analysis is actually you're probably better to leave your money in your pension at this minute in time. You've got an interest rate of 1.5%, in certain cases less, % on your mortgage. As long as you're still working and you're paying that, you'd be better off paying that mortgage and actually keeping your money growing within a very tax efficient environment. So it works pretty well.
I suppose that's the challenge, isn't it? And to Steve's point, and where advice is so important to let people understand those different dynamics that are happening, and whilst it may seem the right thing to do to pay down a mortgage because that's what people want to do, from a financial perspective, it could be the wrong thing to do.
Totally.
And it's about getting that planning in the right way to think about how you structure your overall finances, as well as that sort of rainy day fund that feeds into it.
I think, again, because it comes down to, usually with a mortgage, your mortgage is your biggest outgoing over the longest term. So I think people tend to look and think, right, if I didn't have that for 10, 15, 20, 25 years, whatever it might be, what else could I do with that money? But yeah, you're right. It doesn't necessarily mean that if you pay it off, that's going to be the best thing for you to do, depending on your time of life.
And we're touching here on one of the other issues we need to tackle, and it's inflation, isn't it? Because to all of us, we might hear the inflation rate on the TV, but it's kind of the silent assassin.
Yeah, what does it mean?
It creeps up and it's insidious and it's in the background eroding everything. Yeah. And so you think, well, inflation won't matter. It absolutely will matter. You've got to protect your, savings against inflation. But equally, as you refer to debt, just in the manner that inflation erodes your savings, it erodes debt. So if you can take on a bit of debt and you're in a position and it's prudent to do so, inflation will start to erode the debt as well. So you can play both sides of the coin there a little bit.
Yeah, definitely. It's going back to taking that little bit of advice to say, is this the best need, which is what we're definitely here for. Jeff, just kind of swinging across to the investment side of things. George made a comment in the last podcast I was in, which was about 3 or 4 podcasts ago, around planning for these type of events. But what do the investment team do in terms of doing sort of analysis when you're picking the funds and you're looking to make the strategy decisions on looking at sort of COVID past events, housing market bubbles, tech bubbles, etc.? How do you plan for that?
Well, I suppose what one can do is that you can stress test portfolios. So you've got systems where you can look at past events, their impact on assets, and then we can see how that plays through on the current portfolios. So that's one thing that happens on a very frequent basis. What's, I suppose, a strange thing is that nobody can predict a crisis. So all of the stress tests that you'll ever see in a risk model are based on, with a name, Russian financial crisis, Asian financial crisis, GFC, COVID is now the latest stress test that we now have. So they give a frame of reference, but you can't plan for them. But what you can do is to have sufficient diversification within a portfolio. And that is one of the key tenets of how we think about constructing portfolios. And it plays through to how individual managers build the portfolios, and then how we construct those within the TPP solution as well. So diversification is ultimately the best way to mitigate the problems that one might envisage. But in the end of the day, asset prices will be impacted because they're related to growth. And if growth is impacted by virtue of a crisis, an event of some sort, that will clearly have an impact on asset prices.
And I'm talking about age again now, so I'm going to get told off here, but you two gentlemen are slightly older than Diane and I.
Yes, I thought it was going the other way
slightly.
there.
I think I'm slightly older than Jeff as well. Jeff, you're in my bracket now.
Yeah.
Sorry.
So,
All right,
but
sorry about that.
Yes,
That's
obviously,
what market does.
even I, in fairness, I have worked in financial services in 2 crises and in time I've been in there. So how have, in the years you've obviously worked, how did you feel when, COVID started and you saw markets tweak a bit in terms of, from an investment perspective, how did you both feel in terms of, right, this is how we plan for it? Steve, from a client perspective, what do we need to say to a client? How did you, probably a question for both of you, because you've experienced it more than we have.
Last year, bizarrely, I felt that I kind of knew what was happening. COVID was unusual in the sense that this could be Armageddon, but I gave myself a talking to again. I thought, this isn't going to be Armageddon. We will recover from it. It's going to be a temporary shock. Quite a brutal one as it appeared. But for once in my life, I did benefit from having that hindsight of I was around in 87 and 92 and a few others, and they've spooked me each time they've happened. And in my position at True Potential, obviously last year, I felt that it was good to get that message out to say to people, you really do need to keep calm at this point. You need to stay in your seats. It's going to be really frightening and it's traumatic, but you need to stay in your seats. So we were getting communication out to our advisors and to our clients saying, don't do anything silly. Just as I was saying earlier on, give yourself a talking to. This isn't going to, the world isn't going to end. And if it does, who cares about savings? Because
you don't need them.
It isn't going to end. We're going to come back, but you just need to keep your nerve here. And you've entrusted your money to professionals. They know what they're doing. They haven't seen COVID before, but they've seen market corrections. They've seen, brutal things happen in the market. Stay put, stay in your seat. So for once, and I'm not trying to be clever here, the other times it spooked me out. I mean, 87, gosh, I was young in the market then, but it still frightened me. 92, we had some real bumps along the way, but this time, and even last year, I've got to be honest, when I was telling people stay in your seats, I was nervous, but it was the right thing to do. So stay put.
I think it makes it easier because you have the technology now. So if you think back to, like as you mentioned, 87 and 92, you largely had, the news, like 2 or 3 times a day. That was it. If you wanted information, you didn't really have anywhere to go to find it. You had to wait until the information was presented to you. That's a long time to wait, really, to be told something. Whereas I think now, because we do have the technology, if you need a little bit of kind of confidence, you can go and look for, if you really want it, you can go and try and find it yourself.
I think it's an interesting point to think about how has technology change and speed of information flow potentially exacerbated the speed of movements that you see in markets.
So either way,
So I think the historical context being the speed of correction that we saw last year from the top of the market in sort of the 21st of February to the market bottoming out on 23rd of March. A month for the market to fall in MSCI world terms around 35% is something that's a pretty swift fall. So that is quite unnerving when you see a market falling as quickly as that. But I think it speaks to one of Steve's earlier points that the news flow that you see is always negative, where there's not a balance to it, and that kind of has a self-fulfilling herd mentality that once that starts to take hold, well, it's going to be really, really bad. And it's that narrative that really gets there, and you start to see it in the press. Market plunges 5%, etc. It becomes quite self-fulfilling. You don't see the other side of that the market's risen,
rallied,
has recovered. You just don't. That doesn't sell newspapers. It doesn't grab news headlines. So I think that is something that is worth reflecting on as to whether speed is good or bad. I think Jamie, to your question, you always get nervous when it's in front of you. You just can't not because you're thinking, well, I've got a portfolio here. I know how it should behave in this scenario. Diversification should help, but it's not going to mitigate all of your losses. So losses are real. You can't get away from that fact. There is not a way to protect yourself 100%. That just doesn't exist.
Even with cash as well, by the way, I think that's a really important point, because with inflation, as we're talking about before, so, even with cash,
that is there. So I think you have to just keep questioning yourself, question how the portfolio is structured. Other thing, do you have liquidity in the portfolio? What happens in terms of market stress? Liquidity dries up in certain areas of the market, so ensuring there is liquidity, you can get access to that should you need to make a sale within the portfolio. So that's always at the front of your mind as well. But every crisis is different, and at times last year it was quite unnerving because the normal diversifiers that you would think about in a portfolio were completely correlated. So equities were going down, bonds were going down, gold was going down. That's a pretty unusual mix of things to be happening all at once. That happening on certain days does make you question. Just what is at the back of this. But again, it's about thinking about the longer term. So you take that step back and you think about, well, most of people's savings is for the longer term. It's for their pension. Over the long term, equity markets have generally rewarded. Being invested has rewarded people with the return that they need, and a real return, not just a nominal return. So after inflation, you've had a strong real return from markets. So it's about keeping perspective, but every crisis is different.
It's funny, and you can kind of take a step back with that, and when you look at your objective, say in a 30 years time, and you kind of even look at our portfolios, but if you just sort of dig down into some of the businesses, the airline companies won't be struggling like this in 10 years time. Hopefully not. The majority might not be, but I think the majority of them will. It'll get back to normal. People will go on holiday again. People will fly again. It might change slightly in terms of but when you look at good companies will survive. That's what happens.
They will, and they'll innovate. That's the other side of it. It's if you think about what we were talking about earlier, technology. It's had to innovate. You think about medical technology last year, the innovation that came through in developing a vaccine in the space of 6 months. That's driven by technological change, research change, which if you look at some of those vaccines that have been deployed, they've used really innovative technology. And that technology will now be able to be used in other areas of medical advances, medical diagnosis, but also the ability to create new drugs, which will help other diseases. And that's only coming through. in a very, very short period of time.
It was exciting, wasn't it? You look at the two American vaccines. That is brand new technology.
Yeah.
It's never heard before.
So you look at Moderna's vaccine. It's completely new technology.
Yeah, it's absolutely amazing. Such a fast period of time.
Because what it always, based on everything that you've said, what it seems to come down to is commitment. Now, if you're committed to your investment because you've got a goal, you're likely not going to make a rash decision and, like Steve said, kind of look back and go, oh, actually, I shouldn't have done that, or it was too good to be true, because you're committed to something. When you're committed to the investments, you've largely said, you have to kind of reel yourself back in and kind of calm your own self down by saying, no, this is what we do, and we've diversified to accommodate these issues. We don't know what they're going to be, but we know they're going to come along, but are we in the right position? And in terms of the vaccine, a lot of people don't believe in the vaccine because they're saying, well, how can it be tested? How can it takes vaccines? Do you know what I mean? Like, yeah, it does. But essentially everybody around the world, all the governments were saying, just stop what you're doing. You have got an undefined amount of money. You have got all the research. You've got everything that you need. Just make sure these people are safe. You don't get that when an illness doesn't present itself in the way that COVID did. COVID absolutely pulled the rug from everybody overnight. There was nothing else anybody could do. So again, it was the commitment to just find a vaccine that allowed people to stop what they were doing. Stop there. I don't mean like stop going home of an evening, but the commitment from the scientists and the researchers to actually to find the vaccine that would allow the world to get back to normal. And what we've always spoken about is how True Potential, we would like to think we're anti-fragile. So we look at a problem and we might be robust, and yes, it might hit us somewhere that we're not expecting, but we tend to bounce back from it. And it coming back to the airlines, those airlines, like Jeff said, they'll learn, they'll innovate, and the likelihood is this won't happen again to them in future if they are anti-fragile. If they're robust, it'll hit them, but it won't kind of wipe them out. And you're right, Jamie, nobody really wants to go back to not being able to go on holiday. Nobody wants to. You might look at holidays differently now because, again, your perspectives had to shift. We've spent 18 months not being able to go anywhere, so you have to entertain yourself. So for me, it comes down to how committed you are to your investments, the term of the investment that you have. You have to bulletproof yourself mentally to be prepared for the highs and the lows that come with the emotions that are associated with money. But more like a house. You buy your house hoping that what you've put into it in cash, you have to have a deposit. Where the deposit comes from is, well, it's up to you. But you put that cash down, that's it. You're invested then in that property. But no one's going to say in 25 years' time you're going to make a profit on that. But you've been conditioned to assume. But that's again, it comes back to just the education of what's your money for, what do you need it for, and when, and who are you going to trust with that? Us. So yeah, commitment and education.
Just that'll bulletproof your finances. Let Jeff manage
Well,
it.
there you are. Give it to Jeff. Over to you, Jeff.
It's funny. There must have been some pressure for you, Jeff, because there was 300 and odd staff whose all money is in TP and who you were seeing every day when the markets were going down. So there must have been some severe pressure on your shoulders.
It was
for
Jeff that promoted lockdown, so he didn't have to see
I
us all.
didn't
That's what
see
that
anybody,
was.
so it was fine just sitting in the
we
office at home.
I mean, if you look at historical context again, what we saw last year was a classic V-shaped recovery, wasn't it? It literally went down and then came back up again. It won't always be like that, everybody, as well. If we have a correction, they don't always come back in a classic V.
That's markets do move sideways.
Yeah,
they don't always move up.
Yeah, it's definitely true. You had a really good example, didn't you, Steve? That you ran on one of the advisor webinars, which was kind of showing if that was like the 5 or 6 worst days.
Yeah.
Which was really interesting. If you weren't, I don't know if you can explain it a little bit.
Yeah, basically, it shows how the markets perform if you take out the best and worst days.
Yeah.
And obviously, it makes a massive difference if you miss the 5 worst days, but equally, it makes a massive difference if you miss the 5 best days. Yeah. The moral of the story is you'll never miss them. You'll never time them. Yeah. You are a genius, or you're exceptionally lucky if you manage to get out at the top and then buy in again at the bottom. Yeah. And it is everybody that it's top and bottom, and that's counterintuitive. Investors do tend to invest when it's at the top, thinking, crikey, that's good. Yeah. And then, it's not so good, it's at the bottom. And really what you want to do, if you were a genius of timing, would be to reverse that. Yeah. But the method is, and the moral is, stick with it, and you get the pound cost averaging, you get the averaging out of the top and the bad days, and it really does. It doesn't pay you to be irrational and try and time the markets.
Yeah.
If we remember anything today, it's you'll never time them. Please do not try.
And that's what the technology shows you, though, Steve. Like yourself with the websites, you can actually see it's not just a monetary amount that you see that doesn't really mean anything. You actually get the visual that shows you your projection versus your target and how that's performed, and it does allow people to understand actually this hasn't affected me. Like we talk about the news, you're right, everything that we see is negative and it's just awful. But if you do understand the technology and you're invested and you're committed for the long term, when you look at your website should be a representation of you're in the right place and you're doing the right thing. Without there being somebody there telling you that, you'll become accustomed to what you see, and you might still get anxious. You might want to check your site as soon as you hear something on the news, but the site will show you actually, like, just sit still, just wait for an amount of time. And we always have people here if clients want to speak up and hear somebody say to them, actually, you're not doing the wrong thing, you are absolutely doing the right thing, just, again, calm your bad self down, wait it out, and we'll see what happens.
It's just a natural reaction, isn't it? So I think if we look at our own data, we know that logins go up as the negative news flow comes into the media, so you can see it, and it's right for people to think about it. But then, they, as you say, they can go in and they can see it, but they can also get the content that as a business we're producing to say this is why that's happening. This is why it's important to stay invested.
The volume and the speed of the news is the challenge. We all know journalists, they ring us up all the time, and on a Friday or whatever their day is, they've got to find some news, so they'll write anything. So you don't have the time, because of the volume and the speed, to sort of filter out what is actually worth reading and listening to. You're just bombarded with this, so you can't filter out the good from the bad. So it really, we talk about technology, it really does assist and it's brilliant. However, it is so quick, you've got to be on your mettle to try to filter out the rubbish that comes through as well, which is not always easy.
It's a good point, because you think about, over the time of my career, you see the headlines at the moment, the market plunges and it's moved 2%. You kind of become thinking, well, is that really a plunge? If you think about it, diving, it's not as if you've just jumped off the 2 metre board. But what about that 10 metre or higher board? That's probably a bigger dynamic to drop its way through. But that's because keywords, those words really work in search. So they get them to that prominent view.
Clickbait, isn't it? It's a headline that allows them to click on a site that allows them to earn money. It's largely where that comes from.
And a little bit of knowledge is a dangerous thing. I'm a great piece of evidence on that front. But people talk about stop losses. People say, these markets have stop losses. When it gets to a certain point, they sell everything. Yeah, but they equally have purchase orders on when it gets to a level they start buying again. So don't believe everything you read. Someone who can purport having a little bit of knowledge often is an empty vessel.
So I think, in summary, then, the key for us really is set a goal in terms of where you want your money. Ensure that you are saving towards that goal, and you're putting enough in, and speak to an advisor if you need to have that sort of discussion. And the second thing is, third thing is, if an event like this happens, you just have to ride it out. It's just trust the experts that you're paying for.
We can help you. We can help you protect against inflation. We can help you protect against the taxman. We can help you protect yourself against death, believe it or not. So, there's some things are going to happen to you in your life. You're going to pay tax, you're going to die, you're going to suffer from inflation. You need to see an advisor.
And while I remember, Steve, I'll be available afterwards to set up that junior ISA.
Thank you.
There we are.
No problem at all.
I might well do that, actually.
We'll sort that one out. That one out for young Archie. Because I had to set one up straight away. That was I think you remember, I was on the podcast the day after my paternity was finished. That was the first question I was asked. Not, how's your son? Are you sleeping well? It was more,
give us your money.
Have you set up a junior ISA yet? Which I have done. But I now worry at 18 he's going to have his hands on a bit too much money. But I've got a goal, and he's in an aggressive. So no pressure, Jeff. But it's in your hands. My son's education.
We'll do our very best.
Right, we'll wrap it up now. I think in true podcast style, should we start with you, Steve? What we doing this weekend?
Well, I'm off to London to not see the Queen, but see Alfie George. I can't wait. Great for me.
It is a royal name, isn't it? I suppose, Alfie George.
Yeah, I don't know. Yeah, even my mother, bless her, she's 93, and I told her, she said, Alfred. I said, well, no, Mum, it's Alfie. And she did say, is that a real name? I said, yeah, it is. And he's a real fella.
Same.
Yeah.
We had for my son Jack, we had Alfie and George as names, potential names. Yeah, but I think we're kind of when you see, you just go, oh, yeah, it's a Jack. That was the fell for us. But we did have similar names. Yeah. You, Jeff?
Well, we were in London last week, so catching up on a few things around the garden this weekend. So the grass is desperately needing cut.
Alan Titchmarsh style, or
Yes.
just I've just put that artificial grass down, so I don't have to get involved with that at all.
You're going to hoover it?
Annie hoovers it quite often.
Just remember not to cut it, Jimmy.
Yeah, well, I do have a lawnmower, so there's a good chance that will happen at some point. Yeah, try it. But yeah, no, I definitely, I'm not a gardening man. But and you, Diane, you'd be out of the town, will you?
No, not after today. I'm probably going to be recovering from today
Yes.
at the weekend. No, I'm home alone, so I'm going to enjoy just doing what I want to do and pottering around. Will be some music and some probably trash television. But I'll be bored within 20 minutes and I'll decide that I want to go somewhere. So, but at the minute, no fixed plans. So I'm enjoying knowing that I can if I want to, but I'm not committed to doing anything.
You're going to chill, are you?
I will. I'll chill out.
Well, we sadly bought a National Trust membership. I think that's a good thing, not
It
a sad
is.
That's a
thing.
good thing. Yeah.
And so we've done a few things, so we're going to have a look at that and see where we can go to this weekend. But there's some pretty beautiful places up in Northumberland, actually, which I didn't realise. Benham was so close. So.
We are really lucky.
Yeah, Yorkshire, I'll class that as north as well.
You can house sit for us if you want.
Yeah, no bother. Yeah, I'll be in there, look after the fox.
Get rid of it.
Brilliant. Well, thanks, Ali. That's a really great podcast, everyone. Thanks very much.
Thank you.
Thanks, Jamie.
Well, hopefully, we're our summer party tonight.
Yes.
So hopefully everyone will enjoy that and enjoy it in a sensible way, Diane. I think. Probably not.
That doesn't really go together, Jamie. So we'll scratch that.
And thank you, everyone. Please like, subscribe, and everything else if you would like to view more of the content. And thanks again, everyone. Thanks very much.
Thanks, Jamie.
Thank you, Jim.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.